It's a great pleasure to have with us Wes Gray, managing member of Empiritrage, an investment firm based in Cleveland. Wes will be familiar to many of you as one of the foremost academics in the fields of quantitative investing and behavioral finance. In addition to being professor of finance at Drexel University's Business School, Wes runs Empiritrage, where he puts theory into practice by managing money based on his systematic approach to investing. So really excited to learn more about your approach, Wes, and look forward to hearing what your best equity ideas are currently. So with that, please go ahead.
All right, thanks, Oliver. Appreciate you guys for having me on here with Value Conferences. So starting off, what this presentation is going to be about is really creating efficient algorithms that allow fundamental investors to kind of synthesize the universe from 10,000 stocks down to a universe where they can actually employ their analysts and try to find value. Okay, standard disclaimer, don't blame me if you go broke trying to do this stuff. And so here's how I like to start this presentation off. The first question is, well, why systematic value, or why use some sort of searching algorithm to help you identify the names you actually want to do research on? And what this is this is just a little simple, silly example to show you that what your brain thinks is 100% sure just simply isn't 100% true. So if you look at cells A and cells B, clearly to the visual eye they look different, right? But what I'm going to tell you is that they're actually the same. So all I'm doing is adding little bars here. They still look different, but you'll notice they start to look more and more similar. So I haven't done any magic tricks. All I've done is highlighted that just because of the way it was framed, A and B look different, when indeed they were actually exactly the same. And one quote I like here from Mark Twain is, it ain't what you don't know that gets you into trouble, it's what you know for sure that just ain't so. So for example, if a value investor sees a 50-cent dollar, everyone's like, well, that's a guarantee. There's a company selling for, half its current liquidation value and it's profitable. How can you lose? Well, the reality is sometimes the things that look like they just can't lose are the things that end up costing you the most in the end. Okay, second question is, well, are search strategies important? So I happen to be a big fan of fishing, and I grew up in Northern California around Lake Shasta, which is, if you take I-5 north of Sacramento, a couple hours you'll be there. It's in the middle of nowhere. The problem is, in Lake Shasta, the average bass you catch is less than a pound. They're typically like minnows, right? And so the idea is, even if I catch the biggest fish in Lake Shasta, it's still going to be probably pretty small, right? Whereas if I go fishing in Georgia, the average bass is probably 5 to 10 pounds, which is bigger than the biggest bass in Lake Shasta. So I think one of the keys to success for a fundamental value investor is figuring out the fishing pond you want to go fishing in, because it builds in margin of safety via your searching process. Yeah, so main point is you want to find a way to fish where the big bass are, or in investment terms, fish where the highest return on investment opportunities are. Okay, so what we've developed is this process we call EQV, Empiritrage Quantitative Value, and essentially what the foundation for this is this book that we've recently written. And the impediments behind this book is we looked at the landscape out there of all the research, and there's a ton of stuff, right? Some people promote, okay, use price to sales with momentum, use book to market, use price to earnings, use Shiller PE, use a magic formula approach where you do 50% quality, 50% value, and invest that way. Everything's out there. The problem is no one's actually systematically approached the problem and said, what is the best way to systematically value invest? Or what is the best way to create a systematic value searching algorithm? And that's what this book is about. It also has some of the research that I'm going to talk about here is also based on a paper we have in Journal Portfolio Management, which specifically focuses just on valuation metrics. But the main point is there's a lot of research behind what we're about to go through. So this is the basic process of what we go through, and if you look at it, it's just systematic value investing. So if you were to propose this to Ben Graham 50, 60 years ago, he'd say, yeah, this is just, you've just used a computer to conduct what security analysis do. And so how does this process work? Well, the first process is you identify some universe. We happen to use U.S. exchange traded 1.4 billion and up, which is 1.4 billion is important because that's the 40 percentile market cap benchmark for NYSE stocks. But you could use anything. If you wanted to do this in small cap space, you could. It doesn't really matter. The main point is create a universe that is amiable to your assets under management and what you're trying to accomplish. The next stage, and this is applicable to any investment process, is before you do anything, try to eliminate all the firms that are going to be zeros. So avoid permanent loss of capital. You know, Seth Klarman, Ben Graham, Warren Buffett, everyone talks about this. When you're a value investor, the biggest fear is holding on to that falling knife. It's cheap, but it's going to get cheaper, and it's eventually going to go bankrupt. So Jim Chanos is a big fan of actually buying these sort of stocks, or sorry, shorting these sort of stocks. We want to eliminate these from our sample because we're trying to develop a portfolio of long stocks. So once you've eliminated firms that have a high probability of just going to zero, now we can actually use the algorithms to identify the universe of firms we actually may want to explore. And the second stage we do is we look for cheapness. And I'll explain in a bit why we focus on cheapness so much. What we do here is you kick out the bad ones. Then that 10% of that universe, the 10% cheapest, we then focus on those. We'll talk about how we actually do cheap. Then within the cheapest stocks, we want to separate between the good cheap stocks and the bad cheap stocks. Or in other words, we want to separate from those firms that are the knife that's falling, but we're going to capture it by the handle, and it's a good value investment as opposed to those value investments that are cheap. We're going to catch it by the blade, and it's just going to rip our hand off. So that's a broad overview of how the process works, and I think it should be intuitive to any value investor. It's kind of the thought process that we all go through. Okay, so the first stage is avoid permanent loss of capital, and this is something I think is missing from most fundamental stock pickers searching algorithm. They usually just screen on cheap, maybe do some quality, and then dig in. They don't even really think about using quantitative tools to achieve this means right here, which is to avoid the big losers. So what we focus on is three basic categories. First one, financial statement manipulation. So there's models out there that can predict if this is more than likely or not going to happen. Fraud. Clearly we don't want to be involved with frauds because those are a great way to lose 100%. And then also financial distress or bankruptcy. So these might be interesting after the fact, but you don't want to buy a value stock that's about to enter financial distress or go bankrupt. And why is this so important? This is really important for quantitative models to ensure that you identify manipulators or frauds or potential bankrupt firms, because we're relying on the data to tell us something about the firm. But clearly, if the data has been manipulated or it's fraudulent, then it's the garbage in, garbage out model. It's just not going to work. So it's really important in a quantitative sphere to make sure you eliminate these sort of firms before doing your actual analysis, because bad data is going to present bad results. So, and I'm just going to go through a quick overview of how these different models work, and the intuition, it should be very clear. So one of the first things we look at, just to eliminate from the data set, is firms that have poor accrual measures, either total accruals or another way to account for accruals over time to capture the stock of accruals would be net operating assets. And so why does this matter? Well, let's pretend we have two firms. One's run by a kid named Bernie. Another one is run by a kid named Warren. And let's say these guys are in the lawn cutting business, right? And so they have the exact same business, exact same risk. They do 5 lawns a summer for $20 a piece. But they know they want to sell these businesses at the end of the summer. So they each make $100 in revenue, the 5 lawns times 20. However, there's one of the neighbors out there is just a bad guy, never pays his debts, and nor should anyone that's being, honest about it ever think that they're going to pay their debts. So Warren, being the conservative accounting person, says, you know what, I'm going to take a bad debt expense and write this off. Bernie, who has the ability to kind of finagle this if he wants to, says, well, you know what, I'm going to be selling this firm at the end of the summer. I'm just going to keep that as account receivable because, who knows, maybe he will pay, knowing full well that he won't pay, but he wants to do this manipulation. So what happens is that on the income statement, Bernie is going to look like he has $100 in net income. Warren's going to look like he has 80. The cash flow is going to tell the true story. However, if investors are somewhat naive about interpreting cash flow versus net income, and the end of the summer comes up, these firms are exactly the same as far as economics, but the market pays, let's say, 10 times net income. So theoretically, with the naive market, Bernie is going to get more for his firm than Warren did, even though they're the same exact firm. Now, clearly, over time, the proof is going to be in the pudding, and the cash flow is going to be what matters. However, what you'll notice, and why we use screens that try to capture these accrual manipulations, is it's one of the best way for firms to move the numbers, and they have that power. So the management can actually affect accruals. And it's not that having accruals is bad, because sometimes it's just part of business. However, we're in the business of eliminating anyone that even could potentially be a fraud or manipulator. So if there's a firm that has really, really high accruals relative to total assets compared to the rest of the universe, boot them. If they have really high net operating assets relative to the rest of the universe, boot them. Because we would like to focus on firms like Warren's, where we can actually believe the accounting numbers, whereas Bernie's, we might be able to believe them, but it just may not make sense to go down that path. Okay, so the second thing we look at is there's a model by Benish, 99, a paper in Financial Analyst Journal. It's called the detection of earnings manipulation. And the intuition behind what's going on in the study is pretty simple. What he says is, okay, let's go look at firms that have actually engaged in manipulation. Then let's try to backfill a model that can predict or that can identify the relationship between a set of variables that we think matter for manipulation and firms that actually manipulate it. And the idea being is if you can fit this model going forward, if we know kind of the historical relationship between a set of variables that probably are related to manipulation, and we plug in current values, then we can say, okay, based historically, if we look at firms that actually manipulated, and we look at this current firm's values for these variables, we can identify with a probability of X that they're likely to be a manipulator. And some of these variables, we don't have time to go through all of them. You can just Google Benish's paper to check it out. But DSRI, that'd be days sales and receivable. So the idea here is if all of a sudden firms are allowing accounts receivables to stick in inventory and not get paid fast enough, that could be a situation where the managers may be trying to manipulate. Sales growth is a classic one. Typically, firms that have been having really, really high sales growth also have huge pressure to manipulate. Whereas if I'm a value firm manufacturer, everyone thinks my sales suck anyways, so who cares if I don't, or have great sales next quarter? I don't have that pressure. Whereas if I'm Groupon and my whole valuation is based on amazing sales growth, I have huge incentives to keep the party going. And if my sales growth can't keep up, well, I may have at the margin a higher incentive to engage in manipulation. And there's a story for all these different variables, and that'd be a whole entire presentation. But to highlight that this thing works, here's an example of Enron. So what we do is we calculate the probability of manipulation every single year from 94 up to 2000, which after 2000 is when Enron came out with the huge fraud and manipulation. And what you notice is by using this model, the model was highlighting huge red flags here with 30% probability before it actually came out that Enron was a total fraud. There was a 30% probability that there's some sort of manipulation going on here. Clearly, if there's a 1/3 chance that a firm is engaging in, cooking the books, you would probably want to stay as far away from that as possible. And that's, again, what the point of this model is just boot anyone who has high probabilities relative to the rest of the universe. Okay? So the third category of avoiding these firms that we just don't even want to look at in the first place is firms that are potentially going to enter financial distress or go bankrupt. And what do I mean by financial distress? That might be a situation where they have to go do an equity raise, which is clearly bad for current equity holders because they're going to get diluted. And so how does this model work? Well, it's very similar concept as the Benish model. Let's go look at firms that actually it had financial distress or bankruptcy over the next 12 months, and let's use these firms to then back out the relationship between a set of variables that we think matter for predicting financial distress. So what these the authors came up with, again, this paper is called In Search of Distress Risk. It's by Campbell and a few other guys. You can just Google it. He's a Harvard professor. The variables that seem to matter are this thing called NIMTA, which is basically just net income to MTA, where MTA is kind of like a total enterprise value, but just simpler. So intuitively, it kind of makes sense. If you have higher net income to your MTA, lower probability of financial distress. Here, another measure is total liabilities to your MTA. So clearly, if you have higher liabilities relative to MTA, that increases your chance of financial distress. Cash and equivalents to your MTA, the higher that is, lowers financial distress. Now return. What you do is you actually look at the relative return of this stock compared to the S&P. Firms that have been doing poorly recently, because the market's not stupid, tend to be the firms that also are more likely to engage in a situation where they have financial distress, they go bankrupt. Same thing with recent volatility. So if you see huge volatility, either up or down, that's also a telltale sign that something is wrong here. Size. One of the things about smaller firms is they have less access to capital markets. When things hit the fan, they may be able to borrow, but it's going to be at much higher rates than, say, a GE is going to be able to borrow at. So clearly size should probably be related to the situation. And then finally, and this one's it's kind of a data mined one, but it's in the data, and it kind of captures a lot of probably unobserved variables, is that firms that have a higher stock price, i.e. over 15, tend to have a lower probability of going into financial distress than firms with a lower stock price. This is clearly related to size, but it also may capture other unobserved factors. So now, it's not that any one of these variables tells you what's going on, but the combination of all of them firing off at the same time period may be an indication that you don't want to hold this firm. And here's an example. So when you look at WorldCom, before they had their whole fraud and eventually went into bankruptcy and all these other things, this model right here is predicting a 93% probability that WorldCom would enter some sort of financial distress or bankruptcy over the next 12 months. Clearly, this model would boot that firm. Because 93% is just way too high. That would be crazy. Okay, so that's avoiding permanent loss of capital. 3 screens, 3 simple models to use to at least eliminate, say, the bottom 5% or the bottom 10% from the universe. And how you combine those is up to you. The bottom line is that they work. You should employ them in some form or fashion. The next question is, okay, now we know that we've eliminated the firms that have a high likelihood of going to zero or have a high likelihood of having manipulated data where using quant screens won't even matter because it's fake data anyways. Now let's think about cheapness. And now cheapness, it sounds easy. Well, just buy things that are cheap. Well, it's not that easy because there's 100 ways to measure cheap. And what we've done, and this is admittedly the case, is we effectively went into a data mining exercise. We looked at every single possibility one could even think about. Anything that's ever been posited by a practitioner, an academic, we said, you know what, let's just study them all and figure out who's best. So we looked at all these different price ratios. And what we do is we rank stocks every year, and we either separate them out into deciles or quintiles or whatever you want, and we we say, okay, which of these ratios has the best predictive ability to identify firms that are going to have the highest returns in the future? And likewise, which one also has the ability to identify the ones that are going to have the lowest performance in the future? So we looked at assortment. So we got price to book, price to earnings, price to free cash flow, different versions of enterprise multiples, price to sales, and pretty much everything you could imagine that's ever been positive. Then another idea out there is, well, what about what Ben Graham says? Graham says, well, or what Schiller says, why don't you use an average of past earnings or past free cash flow? Because maybe like last year's earnings for, say, an energy firm are going to be irrelevant because 2 years before that they lost $1 billion. So what we want to do is we want to average the earnings out over the past 10 years, let's say, and then put that over price or that over total enterprise value. So we've looked at all the combinations there, last 12 months, last 5 years, last 8 years. We've looked at, maybe you don't even pick the most recent years because you want to look back in history, so you do years 10 to 5, so on and so forth. Okay, so we look at all those. Now another idea, what about combinations? So the concept here is that, okay, maybe what is going on is it's important you want to use price to book and maybe a price to earnings, because then you're going to be able to capture a firm like, say, Apple or Google, where on a price to book variable, they're going to look terrible, but on price to earnings or price to free cash flow, and especially in the case of Apple, maybe a total enterprise value to EBIT because you pull out all the cash, maybe it's the combination that matters. So maybe we should look at combining all these ratios and equal weighting them. Or maybe for certain firms we weigh the EBIT over total enterprise value more than we weight price to book, so on and so forth. This is just another concept. Test all those. Now the final concept, and this is a referee actually suggested this, is, well, okay, fine, I got you. You've checked all these things out. What about timing? Maybe certain ratios we should be focusing on in certain states of the world. So one idea is maybe in a bad economy, cash is king, so we want to focus on price to free cash flow. Whereas in a good economy, where cash flow doesn't matter as much, it's more about investing R&D and capex to try to generate the top line, and we'll figure out cash flow later. Maybe that's what you're supposed to look at in a better economic situation. Okay, so bottom line is we ran like literally probably 1,000 combinations, and there are some different combinations that work really well. But the next question is, well, we're data mining, admittedly, so we need to think about robustness as well. So maybe in one situation over one time period, you can get a weird combination with the Schiller PE mixed with the current price to book, and you only use that in a bad economy, whereas in the good economy, you just use the price to sales or whatever. And sometimes you can find measures that maybe work better at the margin. However, and there's a big picture highlighting it, total enterprise value to EBIT, which is kind of an enterprise multiple, but you've, without the D and the A here, depreciation, amortization, is definitely the most robust measure. So if you just want to stay simple, robust, something that's kind of like your all-weather cheapness ratio, this is by far and away, in our opinion, and based on the empirical evidence across the globe, etc., the best way to go about it. So even if you don't remember anything from this presentation and you're like, this is way too complicated to do these crazy models with avoiding permanent loss of capital, plug in your Bloomberg terminal to screen on this as opposed to what you used to be screening on, which may have been price to earnings or whatever your favorite ratio was. Because on average, this is going to get you in that bass fishing pond with the biggest bass. This is Georgia, where some of these other ones are Lake Shasta, basically. Okay, and now why is it so important? So this is another insight of this book, and the next slide you'll see what's even more important. But what we have here is this is the distribution of 1-year buy and hold returns since 1972 for every single firm in the universe. And all we do is in the universe of either the top 20% EBIT total enterprise value or the bottom 20% EBIT total enterprise value, which would be like the glamour or the growth stocks. And then we just plot out the histogram. So there's literally like 20,000 observations that make this up. What you notice is that growth stocks have a big issue. They tend to blow up. Okay, we already knew that. Why do people hold them? Well, they also tend, on average, to go up a lot more or have extreme upside movement. So what people are paying for, at least I think what they're paying for, I'm not really sure why anyone holds growth stocks, but I think they're paying for this. They overemphasize this spike here, and they don't think about this spike down here. But clearly the empirical evidence is pretty clear. Growth investing is not a good idea. Because if you look at all the math right here, these are the kind of returns that we really want. You know, like the good positive 0 to 70% in a year. Heck, I'd take that. And look how much more mass of the distribution is shifted towards the right for just using value stocks. I think this picture is pretty clear that being in value or being in growth is a bad bet. It has different tails. The tails are unfavorable, but on average, it's just not a good idea. Okay? So now what's another concept? So another thing that floats out there, and a lot of people really love this idea, is they want to use a magic formula framework. And we originally started down that track because it's so intuitive. And the basic idea is we don't want to be a Ben Graham cigar butt investor. We want to be a Warren Buffett investor. So maybe we will buy high quality, but you know, if we get high quality at a price that's right, it's a great value investment. Where if we buy a cigar butt, but it's going to go bankrupt tomorrow, even though we bought it for 50% in cash, if it goes to zero, it was a terrible bet. So on our original approach, we took that framework. Let's kind of do the mix between quality and price and try to find the best quotient between those two. The reality is, empirically, that doesn't work. And here's why. The reason being is that all the good returns are stuck in just cheap stocks. So what you first got to do is you got to identify cheap stocks, and that's got to be your fishing pond. And then within the cheap stocks, you identify the good and the bad. The minute you don't have that sort of framework and you move to one of these situations where you actually allow yourself to potentially hold a very expensive stock, which is what the magic formula does. So for example, here we have the distribution of firms based on their EBIT total enterprise value. And clearly, firms that are in the top 20% of EBIT total enterprise value, i.e. just cheap value, are all going to be off to the right. However, the magic formula, for the most part, it puts you in cheap stocks, but there's a large portion of the time where it'll actually put you in expensive stocks, at least expensive based just on EBIT total enterprise value. Clearly, the reason it did that is because those firms had high quality. So their EBIT over return on capital was very high. And that's fine, and that's the way that system's supposed to be. It says, okay, well, it's high quality, so I'm willing to pay more money for it. But again, the issue is it forces you to be in a low EBIT total enterprise value bin. And we already know anytime you're in this low EBIT total enterprise value bin, just the statistics or the proofs in the pudding, right? It's like betting on a 2-7 hand in Texas Hold'em. Why would you do that? When the EBIT total enterprise value, the value quotient is like you're dealt 2 aces. So regardless of what your model says, you want to bet with the statistics, right? And so any sort of model, again, that emphasizes quality and price equally is going to have a problem because it's systematically going to force you into expensive stocks sometimes. And you think you're going to be Buffett because you're going to be buying Coca-Cola at 20 times earnings, but Buffett is a total anomaly. It's just not in the data. So in general, if you want to bet on the odds, don't aim to be like Buffett, aim to be like Graham, because on average it's gonna work out better for you, at least historically. Okay, so and then here's some basic results just on a set of different variables. These are just last 12 months, just highlighting how much better enterprise value is. So this again, this is the top, I think quintile, it might be decile, and this is for bigger stocks. These are all firms that are at least over the 40 percentile breakpoint on market cap on the NYSE year in, year out. So this has no micro caps in it. When you go into the small cap space, obviously these numbers get crazy, but you're not actually going to be able to invest in them. And what you'll notice is just on a straight CAGR, this EBIT total enterprise value is clearly better. Standard deviation, they're all about the same. When you look at the Sharpe Sortino, the risk adjusted, it's definitely better. Drawdown, better. Pretty much everything's better. So they're all similar. It's always good to be in cheap, but now that we know we want to be in cheap and we're trying to optimize that, using this enterprise multiple with the EBIT is the best horse to bet on. Okay, so to recap where we've been, first stage in your screening process is avoid the losers that go to zero or go bankrupt. Next stage in your process is identify the cheap stocks, with a particular emphasis on you don't want to build an algorithm that first incorporates quality. You want to just focus on the cheap. Now that we've focused on the cheap using probably a total enterprise value to EBIT sort of ratio, or something that empirically we know is going to give us the best chance of winning, now we want to try to identify who's good within the cheap stocks and who's bad. And that's where quality comes in. So there's a lot of ways to skin this cat. Here's just a framework for how we deal with it. And I'm not going to go into the details here because it would take 3 hours. But these are some ideas and things that work empirically. And in your algorithms or your search screens, you dial in on Bloomberg, you can follow these approaches, and they're all going to be 99% correlated. But the basic idea is that quality stands on 2 legs. Your economic moat or franchise value, your ability to generate returns on investment that are higher than your actual cost of capital. And then, given you have this economic moat, your current financial strength. What the idea being is that even if I have an economic moat, but I'm about to go bankrupt because I can't pay my creditor, I have issues, right? So I need to have the foundation of quality firm is a firm that has an economic moat and has an ability to actually capture it because their balance sheet is strong and they can actually go and attack the market and take advantage of this economic moat. So what are the ways you can quantitatively identify firms that at least historically have shown evidence for an economic moat? Well, what you can do is you can look over long cycles, and we look at the 3 variables here. First thing is ability to generate free cash flow. So what we do there is we say, let's look at your total free cash flow generated over 8 years over your current total assets and rank that against all the other firms in this cheap decile. 1 year you might not be able to generate a lot of free cash flow because you did a huge CapEx investment. However, over 8 years, we should see evidence that this firm, even after including these CapEx investments, we should have seen the return on those investments as well. So this should be highly positive relative to the universe. Okay? What about some other measures? Well, some things we want to look at is return on assets, return on capital. In the Greenblatt formula, they just look at last year's return on assets or return on capital. The problem is that doesn't identify moat, right? Because last year, a oil producer may have 100% return on capital, whereas the year before that, they may have had negative 100% return on capital. And it's clearly not a firm with an economic moat. It's a firm that just is tied to a wild commodity cycle. What we want to look for is a firm that over 8 years has the highest geometric return on assets or return on capital, i.e., the firm that year in, year out, with the lowest volatility, bangs out the highest compound return on asset, return on capital. And we use both of them just for robustness. They're usually 99% correlated, but sometimes weird balance sheet or income statement items come through, or there's minority interest. So it's always good to build robustness in any sort of screen. So clearly, if you've had 8 years of 15% return on assets and it does that every single year, that's evidence of a moat. Now, the final way that you can identify moat, at least via quantitative means, is margin strength. And there's 2 types of margin strength. There's the margin strength of Apple, which is an ability to actually grow margins over time, clearly evidence of economic moat. And then the second type of margin strength is a firm like Procter & Gamble, where year in, year out, they hit 50% margin. And it doesn't matter what people throw at them, they just do it every single year. So even though their margin doesn't grow, it doesn't decrease, and it stays exactly the same. So anyone that can have the exact same profit margins over 8 years, there's probably evidence that they've got something that defends their franchise from getting beat up. So we use these three variables here. Again, everything's measured over an 8-year cycle because that's where you can really start to see if someone has true economic moat. And then we couple that with a 10-point checklist. So I'm sure a lot of you are familiar with Piotrowski's checklist. He has a 9-point scoring table. So what we came up with is we said, you know what, Piotrowski has a good idea, a good starting point, but we can make it better. So what we make is we make a 10-point checklist that improves upon the Piotrowski ideas. And again, this is a checklist that says, okay, we've identified a firm that historically has good moats, but now we need to look at the current situation. And we have a 10-point checklist that just allows you to go down, and if things are all good, okay, great. This is a firm with economic moat, at least historically, but they have the current financial means to potentially dig themselves out of their current hole or whatever they're currently in, because these are all value stocks we're talking about, and they can eventually capture their economic moat again. And for example, one of the things we change is in Piotrowski, he uses just equity issuance. The problem is a firm can issue equity, but that doesn't tell you anything. We need to look at net equity issuance, right? Because you could buy back shares, you could buy back 1,000,000 shares and issue 1,000 shares, and on Piotrowski's score it's going to be looked at negatively as a net equity issuer. When the reality is the net equity issuance is extremely positive, so that would be a good thing. So that's just one example of the improvements we do on the Piotrowski score, and there's a few others, but the main idea is you want to have some sort of checklist that allows you to assess the current financial situation. And now, why does all this work? So the question that people always say is like, well, this is all historical. So our argument is this is a behavioral problem. These are all cheap stocks, and now we're using all these quality measures to now separate amongst the cheap stocks, the good cheap stocks and the bad cheap stocks. And our argument is once you've identified these firms that have the highest economic moat and the best current financial strength relative to the other cheap stocks, what you're really capturing is this representative bias, where what's going on here is investors are basically using the current news to overwhelm the long-term evidence. And let's actually, well, yeah, we don't have time. We'll go through the basic bottom line on the performance here is this thing works really well. Okay, now let's look at the names. So when you just run this was ran in at the end of November, in November, 11/30/2012. Here's the names that pop out. And the question I pose is, well, do you have the courage? And when I say that is all these names are names that clearly have hair on them. For every person that's out there buying, there's a guy like Jim Chanos that says this is the biggest short in the history of the world. So some other names that have shown up on this list are RIM, GameStop, a bunch of value investor graveyard stocks. Now, all I can tell you is that the historical evidence is when you're fishing in this pond, this basket works really well. But some of these, when you start looking at them, are clearly firms that you wouldn't want to touch with a 10-foot pole. And I highlight 3 here in red: Microsoft, DeVry, and Dell. All of these have a clear story of why it's a short. Microsoft, it's a big giant. They haven't moved to the cloud. Apple, Google, everyone's going to dominate them. But guess what? They've shown an amazing ability to generate economic moat and crazy returns in the past. So they have Xbox. They have a bunch of capital. They have a bunch of know-how. They have a bunch of internal knowledge. They've been around the block a few times. A lot of these sort of intangible benefits, may be able to allow them to compete going in the future. And on average, the market's unable to appreciate this. DeVry, okay, for-profit education. Everyone knows that's the worst business probably in the world. Obama will probably eliminate it, et cetera, et cetera. But at a certain price, it may make sense. And if they don't eliminate it, you still have this franchise and this firm that has an ability to generate amazing returns on capital, assuming that the thing stays alive. And then Dell, here's another one. Okay, Dell. Everyone's using mobile computing. Who wants to own the guy that puts the computers together? That's the stupidest business in the world. Well, guess what? Dell knows how to make money. They've been around the block. Sure, the world right now is terrible for them. And there's all the reasons in the world to short it, but that's okay. They've proven at some point they have ability to generate returns on capital, and sure, the current situation is terrible, but the idea is that investors aren't appreciating the intangibles. They've been there before, they've got a brand, maybe they take it to another country and sell it there, who knows, but the idea is on average, baskets of firms that show up in these sort of screens are where you want to focus all your efforts. And that's kind of the punchline of creating better search algorithms and trying to improve your investment performance.
Wes, thank you so much for a very insightful presentation. For anyone who has questions for Wes, I'd like to refer you to our online Q&A area when you log into the conference website at valueconferences.com, or feel free to contact Wes directly. I'm sure he'll love to hear from you. Wes, if I may, just a few questions myself. Perhaps on that last slide, if we can go there for a second. I'm just curious, when you come up with then the result of your approach, a list like this, what perhaps surprises you, or you ask the question, do you have the courage here? Well, based on your approach, do you even need to go into this emotional framework about courage, or is it much more systematic for you? How much time, if at all, do you spend then on looking at the names here and then perhaps confirming backwards, or making any further judgments?
Well, so in our business, we're actually anti-fundamental analysis, so we don't have to worry about having the courage because we just do it systematically. So mechanically, we force ourselves to have the courage, and we don't actually try to go in here and pick the individual names because we're just happy with process over trying to dial down the exact details. So we're just happy with the value that these sort of systems generate just as in a portfolio sense. So having the courage for us is easy because we don't even have to make that decision. We just buy them all. Now, where you would need the courage, though, and where you could potentially generate even better performance is by being the person that can go in here and try to sort out the good from the bad. And that's where you really need to have courage, because all these firms are cheap for reasons that the market clearly hates them. That's why they've shown up in the screens. So you need to be the type of person that's wired to do the counterintuitive or be the contrarian. And yeah, that's why courage is, I put that there, that not really for someone who wants to do this systematically. There you just need to have the courage to push go on the algorithm, whereas the person that wants to actually dive in here and try to sort it out, the minute you start looking at the names and you start reading sell-side research and reading all the stuff out there on the web, is the minute you're going to want to just not own any of these things. But that's where you need to have that courage to kind of go against the grain.
So are these 20 names then the ones that have passed your screens about avoiding permanent loss of capital and the cheapness screen? Is that pretty much a list where you then equal weight, or can you help us understand how far down the process is this?
Yeah, exactly. So I'll just explain it explicitly. So what this list started out from here, and kind of how our investment process works, is this started from an original screen on Bloomberg, because you got to have all the data requirements and the minimum market cap and liquidities of around, let's say, 800. You do the avoid permanent loss of capital screens, and we get down to, let's say, around 700 for easy math. Then what you do is you screen on the 10% cheap, so you're down to 70 names. Then within those 70 names, well, at the very beginning sorry, let me repeat this. So you get 800, you go down to 700 after you've done the void, the permanent loss of capital. Then you calculate all the quality ratios on that entire universe and you rank them against each other. Okay? Then what you do is you screen for the top 10% cheapest, so we're down to 70. Then within those 70, we separated them half based on who has the highest quality. So within those 70, they get ranked 1 to 70 based on quality. And then what we do is we just equal weight for this portfolio, which is the bigger cap ones. We just equal weight the top 35. Whereas we run like a small cap version, but the problem with small caps is there's liquidity issues, so we evaluate that portfolio and algorithms a little bit different. But for these big names, you're exactly right. That's you just equate the names that spit out of it and hold them.
So,
Really
so these are the top 20 of that 35 strong list that you end up with as a result of the approach.
Yep. These are firms that pass the avoid permanent loss of capital screen. These are firms that were in the bottom 10% on cheapness in the universe. And then these were the firms that within those 10% cheapest, these were the top 20 out of, say, 70 or probably 75 that were there.
And just to play devil's advocate a bit, you mentioned Jim Chanos in your presentation. If I remember correctly, Jim Chanos has shorted or is still short some of the for-profit names in the U.S. and DeVry is here on the list. So when you perhaps see a name like DeVry on this list, do you ever think along those lines and say, well, how can I really be sure that I'm going to avoid permanent loss of capital, because here we have a very well-respected person like Jim Chanos, who I'm not sure he has a specific view on DeVry, but it's certainly among the for-profit education stocks which some prominent investors have identified as ones that may go to zero. So how do you reconcile that?
So what we do is we do everything based on there's a hypothesis. So your hypothesis is that there's certain firms out there that maybe we should use a signal from the marketplace that the smart money says you shouldn't buy this no matter what, and you would increase the performance of the strategy. So what we did to test that very hypothesis you just mentioned in the best way we thought that would be possible is we said, well, what about if we look at short interest as another screen? So the idea being is, let's say we get all these names, but let's say the short interest on DeVry is like 10% or 20% or something crazy. So clearly there's a signal from the marketplace that, sure, it's cheap, but it's cheap for a reason. Look how many people are willing to short it or look at the rebate on it. And we did all that analysis, and it turns out that when you do that, you actually hurt performance by a lot. So by using the market signal and the quote-unquote smart money that thinks they're shorting the stocks that are going to blow up, in this context here, we're using this screen on these particular names using our algorithms, it actually hurts performance. Now we know in general by front-running firms that have high short interest, if you didn't have to pay the cost of the rebate, those firms do tend to underperform. However, in this context here, after the fact, when we've got these names using our algorithms, and then we try to apply like the short interest rule where we kick anyone out where like clearly the market is signaling that you shouldn't be in it, it like literally destroys performance. And our hypothesis on why that finding may be true is that it just kind of goes to like the core of what it means to be a value investor. If people are out there shorting the heck out of one of these DeVry stocks, the price is now, it's just so depressed, it's so cheap, it's now probably entered like the Ben Graham cigar butt category, and you've got to be going against Chanos and everyone when he posts or says something, at Value Investor Congress, like everyone's like, oh my God, sell it. You could even argue the same for Einhorn, right? So they may be right, but the problem is you're almost, even though you think you're still a value investor, by following those guys in the herd, you now also become part of the herd. So I think a lot of these rules where you try to use like the quote-unquote smartest guys in the world to make your investment decisions, at least based on what we found, and like I said, we're more scientific based. We don't operate on inside scoop or anything, just strictly on the numbers, and we just gamble that way effectively. It just doesn't work. So I don't know. I agree intuitively. Like on all these things, if one of these real famous investors is short it, why in the world would we want to be long it? Well, it's because the algorithm says it, and the algorithm we know on average is right, even more right than the smart guys out there. So, and that's just our philosophy, is we're just going to stick with it. As Jim Simmons says, you waste all your time building this model, just follow the effing model. Don't try to nostalgia. You're going to be a quant, be a quant. Don't try to be like, everything to everybody. And so that's kind of the track we've taken.
So the point here is then specifically with DeVry is that DeVry did pass your, was it three screens related to the permanent loss of capital? And then related perhaps to this is also the point about the equal weighting. Can you talk a little bit more about the portfolio management aspect then, you know, why 35 names and why equal weight them? Can you give us a bit of sense around that?
The basic reasoning on that is, well, if we deal with family offices, so most of the stuff we do has got to be focused on tax management. But the basic philosophy behind why 35, why not do 50, or why not do 10? Well, I don't know if you remember back to your, investment 101 investment management class, but what you have is for diversification, there's kind of an asymptotic line. The basic thing is the benefit of diversification, you kind of lose, or it's very marginal after around 30 to a 40 stock portfolio. So the variance that you can lower by going from, say, a 30 stock portfolio to a 200 is like, hardly anything. Whereas the lower, or the less variance you can get by holding a portfolio of 30 versus 10 is huge, right? So 30 is kind of that sweet spot where the trade-off between the number of names is sufficient enough to capture, say, 98% of the benefits of diversification. And that overwhelms the cost, which is now that you're not as concentrated in the model. Right? Because theoretically, and it actually is true, if you do more concentrated portfolios, you're going to get better returns. But the problem is that variance gain trade-off is just unfavorable. So 30 to 40 names is kind of that sweet spot. And that's one of those things as well where you don't want to, when you're doing model, you're doing quant, if that's the path you want to take, you gotta have like what I call don't believe in your own bullshit at some level. You always got to be skeptical of your own model. So you want to use the model, but the minute you start dialing down the model down to like the decimal point is the minute you start believing your model too much, and that's the minute you start getting the same problems that everyone else has. You get overconfident. You think, well, let's just hold the top 5 in the model because the model works so well. When we just do the top 5, we'll make 100% CAGR a year. And the reality is the minute you believe a model is more than just a model is the minute you kind of destroy the whole benefits of of not suffering from all the behavioral biases and everything. So that's why we focus on like the 30-35 range, just because it captures most of the benefits of diversification, and it also allows us to make sure we have, hold a somewhat diversified portfolio. Now the next question is, well, why do you equal weight? You don't have to. Equal weight's nice from a risk management perspective, because if you evaluated it or if you weighted it based on some sort of algorithm that says, okay, the number 1 guy gets 15%, the number 2 guy gets 10%, so on and so forth. 1, that adds complication, and then 2, that makes risk management a little bit more difficult, because if you start off, and a lot of these names, the way we do in the tax management accounts, you hold them for a year. So if you start off with, say, 30 names, you got, let's say 3% each name. Whereas if you do like a value weight system, or you do a system that kind of overweights towards the best names, you may start off with a name being 20% of the portfolio, and that's not very good risk management, right? Because now you've got 1/5 of your capital tied to one name, and now you're kind of shooting yourself in the foot with respect to the diversification benefits you're trying to get. So that's why we do equal weight, because it's just like a dumb way to have a robust portfolio that starts off with. You're not over betting on any one name. You're just betting on the pool. So it's almost like you're betting on the big fish pond, but you're not trying to bet on any one of the individual bass within the pond. And we just think that's a more robust, kind of safer way of going about it than trying to do fancy algorithms to try to weight within that portfolio.
How often do you rebalance then? This list is as of end of November 2012.
Yeah, so we've obviously done all that work. Again, the problem is our client base is tax focused, and the difference between 15% tax and 50% tax, you have to have so much alpha it's not even funny, not to mention like all the trading costs of doing a more high frequency. So we also do this at much higher frequency rebalances, and the returns go way up. The problem is, so do the costs, and you eliminate all the benefits of tax management. So there is a benefit to doing this more high frequency, because then you're going to always have the freshest names in there, but it comes at a huge cost, because now you can't tax manage a portfolio, and there's a lot more operational complexities, etc., etc. So I guess the thing is, yes, if you do it more high frequency, you get more value, and the names are going to churn a lot more, but we know it works by doing annual holding periods, not as well, but good enough, and then on an after-tax basis, it's way better. So that's why we focus on it for the most part, doing annual rebalance.
Based on all your research into investing and the quantitative approach that you employ, what would you say is the biggest challenge of this approach?
I think the biggest challenge to any of these sort of approaches, if you want to do them systematically, is, again, what Jim Simmons says. If you're going to be a quant, you've got to follow the model. And as mentioned, one of our investors who invested in Steel Partners way back in the day, and he's invested in all these fancy managers. He's been in like Man Group, like all the best managers in the world, and he's been in a bunch of the worst ones. He says the #1 issue I see with managers is style drift, especially quant people. They start off with a model. They start watching it run live. They see the daily returns. They see the monthly returns. And they say, oh, we need to tweak that. We need to tweak this. But after 5 or 6 tweaks, the model that you're now running is not representative of the model you actually tested, and now you're completely out of the game. So I think the biggest challenge to doing this stuff specifically is actually having the discipline and I guess the courage to just do the model, and just listen to the algorithm and not try to overthink it. But of course that can be scary, right? Because once you lose a few names, or you have some underperformance, or you see like your DeVry position go down 90%, you're like, God, we need to now kick these out, or anything that Chanos owns short, we just want to eliminate from that from the portfolio. But now you're starting to move down that path of changing the model from its original format, which is insanely easy to do, but it's going to shoot yourself in the foot down the road.
Well, Wes, thank you again so much for your time and all the insights.